Welcome to the press webinar for the launch of the International Energy Agency's Global EV Outlook 2022. I'm Jethro Mullen. I'm a senior editor and writer in the Communications and Digital Office of the IEA, and I'm joined by the head of our Energy Technology Policy Division, Dr. Timur Gul, and the lead author of the EV Outlook, Leonardo Paoli, a clean transport analyst. We will start with a presentation of the key findings of the report, and then have time for a Q&A. As you may know, you can put your questions into the Q&A function in the Zoom. We invite you to do so anytime during the presentation and or shortly afterwards. So without further ado, I will pass the floor to Dr. Gul.
Yeah, thank you very much, Jethro, and good morning, good afternoon, good evening from Paris. Great pleasure to be here with you today for the press webinar for the IEA's annual Global EV Outlook. Let me start with a couple of words of background here. The Global EV Outlook is the flagship publication of the IEA's Electric Vehicle Initiative, which is an initiative under the Clean Energy Ministerial dedicated to accelerating the adoption of electric vehicles worldwide. It was established under the Clean Energy Ministerial in 2010, and the IEA has been its coordinator ever since. It's a multi-government policy forum that is dedicated to supporting the design and implementation of domestic electric vehicle deployment policies and programs. And within that initiative, we as the IEA facilitate exchanges between government and with a variety of different partners, such as from the industry. A key output of this initiative is this Global EV Outlook that we've been publishing for 9 years now, the first time published in 2013, and it's the subject of today's webinar. When we sat here 1 year ago to release our last Global EV Outlook, our discussion was much around the climate benefits of electric vehicle. This is still an important topic. It still holds true, of course. The recent IPCC report was an important reminder just how urgently we need to act on climate change. Today, however, after the beginning of Russia's invasion of Ukraine, another important benefit of EVs has come to the fore of public attention, public and policy attention, I should say. EVs, of course, run on electricity and can therefore be an important contributor to reducing the use of oil. As my colleague, Dr. Leonardo Paoli, will tell you in a couple of minutes, there's much good news to be reported from electric car markets. In fact, few areas in clean energy are as dynamic as electric car markets. Sales of electric cars have doubled since 2021 to a new record of 6.6 million, meaning that more cars, electric cars, are now sold in the span of 1 week than in the whole of 2012, just about 10 years ago. Now that the first quarter of 2022 has passed, we still see no sign of slowdown. Quite the opposite. Sales were actually up by around 3/4 year-on-year in the first quarter of this year. When stacking up government policies and other targets from around the world, it is very clear that there is a strong future for electric cars to meet the climate goals announced by different countries around the world. The share of electric cars in global car sales would need to reach 35% by the year 2030, just to meet those targets that countries individually have set themselves. To reach net zero emissions by 2050, as we laid out in our landmark report roadmap last year, the share would need to be 60% by the year 2030. So still quite some way to go. Such a promising future will not come about without targeted planning. The recent strains that we have seen across supply chains for both conventional as well as electric vehicles are an important signal here that the future needs preparation. The distinctive feature of EVs relative to conventional cars here is the battery supply chain, which currently is as my colleague Dr. Pauli will tell you in a couple of minutes, centered by and large around China. China is the global leader not only of electric car sales, but also of most other parts of the EV battery value chains. Many countries are racing to catch up. We see plans in Europe, in North America, and in many countries in Asia. But as Dr. Pauli will explain you in a second, for the future, building a sustainable and resilient value chain will require to anticipate potential bottlenecks, in particular for the supply as well as the use of critical minerals. In closing, let me just say that from the IEA, we will continue to monitor progress on electric vehicles, and not only for cars, of course, but also for other modes of transport, as well as we do for any other part of the energy sector. And we will continue not only to analyze, but also to support actively electric vehicle deployment through working with governments around the world to put in place the right policies to support them, including through our electric vehicle initiative, an initiative that is in these particular times more important than ever. With that, I will now pass the word to my colleague, Dr. Leonardo Pauli, who will present the key findings of this year's Global EV Outlook 2022.
Thank you very much, Dr. Boom. These are indeed extremely dynamic times for the electric vehicle markets, and it will be my pleasure to navigate you through some of the findings and key figures of this year's analysis. So let's begin by looking at the sales data. Electric car sales have been on the rise for the past decade, and 2020 was a particularly important year, as electric car sales have increased even though the overall global car market has stumbled as a consequence of the global COVID-19 pandemic. In 2021, overall car sales kept decreasing in some countries, but overall the car market is up roughly 5%. Electric car sales, on the other hand, grew much faster. 6.6 million electric cars were sold during the course of 2021. That is twice as much as in 2020. As the figure shown here clearly shows, China accounts for half of all the sales, and as more electric vehicles were sold in China in 2021 than in the entire world in the record-breaking year that was 2020. In terms of market share, the electric cars accounted for nearly 10% of the overall sales, and in more advanced markets such as Europe and China, this share was actually closer to 15%. There are many reasons that explain this exceptional growth, and they differ by market and region. However, I would like to highlight three key drivers of these global trends. First of all, in Europe, there is a strong regulatory environment that is favoring electric vehicles. In particular, the EU-wide CO2 emission standards are key, and these standards have become more stringent in 2020 and in 2021. In addition to this, the generous incentives that have been put forward by several EU member governments in the wake of the pandemic have further improved the case for electric vehicles in this market. Second, in China, here national EV subsidies have actually gone down, and the EV market has proven to be resilient to this change. And this is what we think is an indication of increasing market maturity in China. Indeed, an average electric car in China is only roughly 10% more expensive than just an average car. This is due to a few reasons. One of them is that electric cars in China tend to be smaller than average internal combustion engine ones, but it is also because there are economies of scale and a developed supply chain that helps keep costs for EVs comparatively lower in this region. Third, there is an increasingly strong ambition to electrify in the automotive industry. Several automakers are now actively competing to have an advantage in this market, and are therefore introducing several new models that are attracting more and more consumer demand. Given this premise, there is no reason to think that 2021 electric vehicle sales were actually just an outlier. As you can see from the graph on the right, early market data is showing a continued strong momentum in 2022. In fact, in the first quarter of this year, around 2 million electric cars were sold globally, and that is a 75% increase compared to the same period last year. China continues to drive the global electric car market. And in fact, the Chinese government has a target for new energy vehicles to account for 20% of all car sales by 2025. But it is quite likely that China will meet this target earlier. Actually, this level was already reached on a monthly basis in December 2021. This sounds like good news all around. And indeed, a few areas are as dynamic as the electric vehicle market. But electric vehicles are not a global phenomenon quite yet. The three major markets that are highlighted here, Europe, China, and the United States, account for 95% of all electric car sales. But when we look at the overall car market, they only account for roughly 2/3 of the total. Progress in electrification has been much slower in most developing and emerging economies, where actually the sales share of electric cars has been mostly below 1%. Now, if we look into the longer term, we have developed an outlook to 2030. It should not be surprising that our current expectation is for Europe, the United States, and China to continue leading in global EV sales. In terms of government ambition, the European Commission has proposed to effectively phase out the internal combustion engine by 2035. The United States has a target to have 50% of all new car sales being electric by 2030. And in addition to these ambitious government targets, the plans that have been brought forward by major manufacturers suggest that even more is possible. Right now, the two largest automakers in the world have targets to sell several million electric vehicles by the end of this decade. And many other OEMs have actually similar ambitions. Put together and taking into account the net zero emission ambitions of all countries from around the world, we believe that electric cars their sales share will increase significantly, and it will move from roughly below 10% today to 35% in 2030. And this would result in 250 million electric vehicles on the road by that date. This is still well below the 60% that would be required by 2030 to be in line with the IEA's pathway to reach net zero emissions by 2050. However, it is clearly a major leap forward. It is important to recognize that electric vehicles are also making inroads in other transport modes. Electric truck sales currently account for less than 0.5% of all sales, and they are mostly found in China. But there are plans to expand. The model availability for electric trucks outside China is increasing, and right now there are roughly 170 different electric truck models that businesses could choose from. It is still unclear which role electric and hydrogen fuel cell trucks might take in different countries, but government support for zero-emission trucking is increasing across the board. At COP26, 15 countries announced their support for the Memorandum of Understanding on zero-emission medium and heavy-duty vehicles, which aims for new heavy and medium-duty vehicles to be electric and have a market share of 30% by 2030. All of this means that in our announced pledges scenario, electric trucks account for 10% of all sales at a global level by the end of this decade. The electric vehicle transition will change the way we move around, but more importantly, it will change the way we consume energy for transport. First of all, it is important to note that electric vehicles already contribute to reducing oil demand today. In 2021, roughly 0.3 million barrels of oil per day were displaced by the use of electric vehicles. And this was mostly thanks to the use of electric cars and electric buses. The strong expected growth means that by 2025, around 1.6 million barrels of oil per day could be avoided by electric vehicles. And this number, to put it into context, is roughly equivalent to the oil consumption in France. By 2030, as much as 4.6 million barrels of oil per day could be avoided by the use of electric vehicles. Instead of oil, clearly, EVs use electricity. Today, their consumption of electricity is relatively little, given that there is still a moderate number of EVs on the road. But by 2030, EVs could actually become a real electricity demand segment of their own. The total demand expected in 2030 is actually just slightly lower than today's India electricity consumption. All of this has many implications. For energy security, it shifts the focus from oil onto electricity and electrical grids. And for the environment, there are clear net positive effects. Already last year, electric vehicles were avoiding 40 million tons of CO2 being emitted in the atmosphere. And this takes into account the emissions that are associated with the generation of electricity. By the end of the decade, if government pledges to decarbonize electricity generation and increase road transport electrification are realized, 500 megatons of CO2 could be avoided. And as a point of reference, this amount is equivalent or actually more than the CO2 that was emitted in the whole of Brazil in 2021. But for all of these benefits to be realized, electric vehicles need to be manufactured at a massive scale in the first place. And to manufacture an electric vehicle, we need batteries, their components, and the minerals that are required to produce them. In other words, we need to build an entire supply chain. Triggered by the semiconductor shortage that affects the overall automotive industry and has affected it for several months, as well as due to the long lead times that are and delivery times that are being witnessed for conventional and electric cars alike, global supply chains and the way they work have been a key discussion point as of late. As electric vehicles become an ever more important powertrain, it is increasingly important to ensure a stable global supply chain. There are many similarities between conventional cars and electric cars, but the battery is the key distinctive feature of an EV. But what is involved in the manufacturing of an EV battery? First, there is the extraction of raw materials and raw metals that needs to take place. Current batteries are mostly composed of lithium, nickel, cobalt, manganese, and graphite. These raw minerals usually exit the mines as concentrates, and these need to be chemically processed and refined to be turned into chemical components that are suitable for the following manufacturing steps. These refined chemicals are then used for the manufacturing of battery cell components. And the two main ones are the anode and the cathode material. The components are then assembled to form cells. And this is the smallest functional unit of an EV battery. Groups of battery cells are then assembled together to form a battery pack. Finally, the battery packs must be integrated in the electric vehicle, usually at a vehicle assembly plant. When a battery reaches the end of its life for a vehicle, it can either be reused for lower demanding applications, or it can be recycled. But so how does the global supply chain look like today? As mentioned earlier, China has the largest market for EV sales today, but it also holds the lion's share of EV manufacturing. In fact, the share of global production is even higher than the share of global sales. In terms of battery cell manufacturing, China is home to 3/4 of installed global battery capacity. And in addition to that, the largest battery manufacturer by volume is Chinese. This capacity will need to expand in the future. And to give a sense of scale, today we are manufacturing roughly 340 gigawatt hours of batteries every year. And by 2030, we could need roughly 10 times more than this. And to produce that number of batteries, we would require the full output of roughly 100 gigafactories. Over the past years, there's been a strong push by governments and industry in Europe and in the United States to secure a place in battery manufacturing. Two important policies that are worth highlighting are the important projects of common European interests that have been focusing on batteries, and on the other side of the Atlantic, the US bipartisan infrastructure law. The related investments are expected to double the global share of manufacturing capacity in the United States and Europe by the end of this decade. But it is still expected that by that date, China will still retain the majority of manufacturing capacity. Now, when looking at anode and cathode material manufacturing, which are the two building blocks of a battery cell, Chinese manufacturing capacity accounts for 85% and 70% respectively of global total. The remainder is located primarily in Japan and Korea. In fact, some of the manufacturers with the longest history and with a technological edge are Korean and Japanese. These are highly specialized industries with fairly high barrier to entries, but some European and American chemical companies are starting to invest in this sector. Now, the processing and refining of raw battery metals is also mostly a Chinese story, with over half of the refining capacity for lithium, cobalt, and graphite being located in China. Nickel, on the other hand, is more often processed close to where it is extracted. And now finally, in terms of raw materials extraction, there are a number of important players. Lithium is mostly coming from Australia and South America, nickel from Indonesia, Australia, and Russia. Cobalt is mostly mined in the Democratic Republic of Congo, while graphite is almost exclusively mined in China. The geographical concentration of battery raw material extraction is actually higher than it is for the oil and gas sectors. But at the same time, the distribution of reserves for these minerals are geographically diverse, meaning that at least in theory, there is room for further diversification. Over the last year, the price of many of these commodities that we're talking about here has skyrocketed. The price of lithium, for example, is now 8 times higher than it was at the beginning of 2021. And this is showing that the market for these commodities is clearly tight. And that is mostly due to higher than expected battery demand. And so all of this begs the question of whether we have enough metals and minerals to support the electrification ambitions that we have mentioned so far. To answer this question, I would like to first of all point out that there is not only one way to make an electric vehicle battery. In fact, there are several possible chemistries that are available, each with their own specific strengths and weaknesses. The chemical composition of batteries has greatly evolved over the past 5 years, and it will certainly continue to do so thanks to efforts in research and innovation. Currently, most batteries have cathodes with high contents of nickel, but LFP, which is a chemistry that does not require neither nickel nor cobalt, has doubled its market share in 2021. Actually, the demand for minerals today is a function of the chemistries that we are using and that we have chosen. When we look to 2030, we expect the share of LFP to increase. And this is due to, on the one hand, a number of innovations, such as the cell-to-pack technology, that are making this chemistry actually rather well suited for entry-level and mid-level electric cars. But in addition to this, we're also expecting new and innovative chemistries, which include manganese-rich cathodes, as well as totally new sodium-ion batteries, to start gaining market share by that date. Now, when we look to 2030 in the announced pledges scenario, which is a scenario that takes into account all of the announced government ambitions, we see that the demand for battery metals will increase substantially and actually exceed projected supply. And that is especially the case for lithium. This is a call for additional investments in mineral extractions to be happening today. But as I mentioned, the chemistry composition of batteries is not fixed. If battery metals market remain tight and commodity prices remain high, it is possible that automakers will shift more rapidly towards chemistries that are less intensive in terms of critical metals, and that they will speed up the research and development for alternative chemistries. We actually explored this possibility by developing a constrained chemistry case. Here, innovative chemistries enter the market more rapidly, and LFP takes a larger share of demand. In this case, the gap between expected demand and supply looks different. For cobalt and nickel, expected demand becomes lower than expected supply, while for lithium, additional investments are still required, irrespective of the chemistry choices. Therefore, governments and market players must closely monitor both the supply and the demand side of the equation to anticipate bottlenecks that might occur across the EV supply chain over the coming decade. Let me just add one word of caution for nickel. Even if the overall supply of nickel does not appear to be particularly short, not all nickel resources can be used for battery manufacturing. It is therefore important to develop existing and innovative routes to transform lower grade ores into battery grade nickel. And now let me conclude with 5 key policy recommendations that stem from this year's analysis. First of all, we need to maintain and adapt the support for electric cars. Growth is rapid, of course, but it can by no means be taken for granted. A clear policy framework that includes increasingly stringent CO2 or fuel economy standards must be kept in place, or it must be introduced where it is absent. Additionally, it is important for governments to adapt their subsidy policies. Simple incentive schemes can become unsustainably expensive over time with these growth rates. Second, we need to kickstart truck electrification. Trucks account for 12% of total oil consumption, and they account for 20% of all oil used in transport. The increasing availability of new electric truck models and a decreasing total cost of ownership mean that now it is the time to double down our efforts. Policy initiatives such as zero-emission vehicle mandates or CO2 emission standards can kickstart electrification in this important sector. Third, we need to promote the adoption of electric vehicles in emerging and developing economies. There are some promising dynamics in terms of 2- and 3-wheelers and then buses in these countries, but the sales of electric cars have only picked up very slowly. High purchase costs and the lack of charging infrastructure are key issues here, and this needs to change. Fourth, we need to expand EV charging infrastructure and electricity grids. Our analysis shows that most distribution grids in major EV markets should be able to cope with the EV charging loads, at least up to 2030. But investments in tomorrow's grid must begin today. The deployment and development of digital technologies for smart grids should be incentivized. At the same time, public and private charging infrastructure must also continue to be rolled out. And now, last but not least, it is essential to develop a strong and resilient EV supply chain. Without this supply chain development, the EV transition will simply not be possible. Each step of the supply chain must be expanded, but our analysis shows that the mineral extraction step is the most critical. And this is due to the long lead times that are involved with its expansion. Therefore, investments must be made right now to avoid any potential bottleneck down the line. Thank you very much for your attention. I will now give the floor back to the moderator.
Thank you very much, Dr. Pauli, for the presentation, and Dr. Gül for the introductory remarks. We're now just going to take a quick 2-minute break to give you time to submit your questions. So we'll be back very shortly to answer those questions. As mentioned, you can put the questions in through the Q&A function in the Zoom. So please do so now if you haven't already. Thank you. Welcome back. Thank you for the questions that you've submitted. We're going to go through them now. The first one is from Amina Saeed from S&P Global. She's asking, is there any data to show what source of power EVs are using, as in coal-fired power or natural gas or renewables? And then we also have a question from Steve Levine from The Electric. He's asking, what do you expect the dollar to kilowatt hour cost of lithium ion batteries to be at the end of this year? So I think Dr. Gül is going to take the first question and Dr. Pauli the second.
Yeah, thank you, Amina. And it's an excellent question, and it's unfortunately not that straightforward to respond to. I mean, there's a couple of variations to look at here. One is obviously where the cars or the electric vehicles are running. So we all know that China's power mix is heavily coal-based. European power mix is very different by country. In fact, US power mix is looking different as well. There's also a question as regards the time of day at which electric vehicles are being recharged. So we don't have an immediate answer to you on this one, but we'll be happy to follow up with you after this call.
Thank you for the question. So of course, making any statement about future battery prices depends on a number of factors. One analysis that we've done is that we have taken the prices that we've seen for commodities in the first quarter of 2022, and we've applied those to, let's say, a battery cost model. And by doing these calculations, we saw that the batteries could become on average roughly 15% more expensive in 2022, but that is if the prices that we've observed in the first 3 months sort of stay constant throughout the year. However, there are other factors such as increased utilization rates of battery factories and just the learning by doing effects that we have observed year on year, and these are likely to bring this cost to shrink this calculated cost increase. So this 15% should be thought as a potential maximum price increase.
Thank you very much, Dr. Pauli. We now have a question from Farid Rahman from the National. His question is, what is the outlook for EVs in the Middle East? And then also a question on China. China is the market leader for EVs. What do you make of government announcements aiming to reach 20% of EVs, to reach 20% of EV sales by 2025? I think this means the EVs making up 20% of overall car sales. So with the Mideast question, I think Dr. Pauli, and then Dr. Goel for the China one.
Yes, thank you very much. So the net zero emission pledges in countries such as the UAE and in Saudi Arabia are likely to have positive impacts on EV deployment. There are also some specific targets. For example, in Saudi Arabia, there is an aim to have 30% of all cars being electric by 2030. And this has been pledged following the overall broader pledge to reach net zero emissions by 2060. At the same time, in the UAE, there is a target to deploy 42,000 electric vehicles to make sure they are on the streets by the end of the next decade. So these are some examples of specific policies that have been put forward in the region. And I hope this answers your question.
Yeah, thanks. I'll take the next one on China maybe. Now, China has a track record of really overachieving on its targets. We've seen that with solar PV, and from my personal perspective, we're currently seeing this with electric cars. It's a very ambitious step into the electric vehicle market, of course, that China has been taken. And when you look at just the data, then by December last year, we already had 20% of sales being electric in China. This is obviously just 1 month. It's important to recognize that. And the target for 2025 is to reach 20% throughout the entire year. But I wouldn't be surprised if China would be overachieving on that particular target as well.
Thank you for those answers. I think we've had one more question that we can squeeze in before the end. This one is from Pier Giorgio Sandri from La Vanguardia, asking, could you confirm that the average EV price is 40% higher than conventional cars? I assume that means a global average. And can the rise of raw materials increase the prices in the short term? So I'll pass that over to Dr. Pauli.
Thank you very much. So indeed, in our report, we have calculated that just to be specific, the average price of an electric vehicle sold in 2021 was between 40 and 50% higher than the average, let's say, conventional car, irrespective of powertrain. That is the number that we have. However, these numbers are relevant for Europe and the United States. In other regions, namely China, this difference is much lower, is at roughly 10%. Now, the rise of material increases of material prices, of course, will have an impact to overall end product prices, but there are several steps. As mentioned earlier, in terms of the battery, it is not clear how much or whether the battery prices will increase. And it is important to note that it is not just the battery metals and the battery materials that have increased in price. It is all commodity prices that have increased. So what matters? So it is not clear whether next year or in the following years we will see an increase or a decrease in the price difference between conventional and electric cars.
Great. Thank you very much, Dr. Pauli, for the presentation and your answers. Thank you to Dr. Girl as well for his remarks and answers. And thank you to the journalists for the excellent questions. As you know, the report is fully available on our website. And please do get in touch if you have further questions that didn't get addressed in this webinar. You can reach us at press@iea.org. Thank you very much. This concludes our press webinar for today. See you all soon.